For our COBT listeners and viewers, it's Maynard, Mike, and Jeff here with something super fun. It's an old friend to talk about the world's capital markets and M&A markets and activism markets and investor attitudes and what's going on in boardrooms around the world. I'm talking about Bill Anderson. Bill is an old friend from Goldman Sachs days. Much more recently, Bill has become senior managing director at Evercore, where he heads the firm's activism and raid defense practice, as well as the strategic advisory practice around the world. Just to give you a feel for it, and Bill, I was looking at your bio. This is a lot of flavors, but when as the audience thinks about what you get involved with, M&A, special committee situations, corporate governance issues, cross-border transactions, contested shareholder situations, activism, raid defense, and preparation for hostile situations. So, I mean, Bill, this is, if this had an SIC code, I mean, this is a lively spot in the world.
Well, what's important, Maynard, is I bring a lot of experience because I was a banker, both at Evercore and then 15 years as a partner at Goldman. But I was a lawyer before that at Simpson Thatcher, accountant. And because defense clients needed, I was in the Army and Army Reserves for 10 years. So we bring the full skill set, I hope.
Well, it's great. We'll try not to make this old home week, but Bill, I remember in the early days of activism and how it related to M&A and how you were an early investor in that space and really helped build the space. So we're delighted to have you.
Well, I can tell you, Maynard, it's one of these things you kind of backed into, right? So Goldman, I was working on a lot of pooling of interest, if you remember those deals back in the day in the late 90s. And Goldman said, come on over. This is a real specialty. And of course, pooling of interest went away. And then we had a tech bubble pop. And they said, well, you were a lawyer by background. Look at this defense stuff and special committees. And I had a terrible summer associate job when I was at Simpson, reviewing Payne Webber. Remember, thank you, Payne Webber? They had these filings called 13F filings they messed up. And I had to fix it. I'm like, oh, my heavens. This is where Carl Icahn and Peltz recorded their filings. So for years, we tracked it and had 90% market share on that. And they drive so much of M&A. It's been a very interesting practice, we'll say the least.
Well, Mike, before we jump in with Bill, what would you tell us about what's going on in the markets today?
Yeah, Maynard, things are, we talked about it last week about volatility in the markets, and I'd say this week so far, it's not been that volatile, to be quite honest with you. Now, we did have the 10-year bond yield today is down around 415, which is down 7-8 basis points. So bit of a plunge in 10-year yields today, and that was because of lower December retail sales. Now, this Friday, we're going to have the CPI number, so expect a lot more bond volatility around that number on Friday. As far as WTI, we seem like we settled in a range here between $63 and $65 a barrel. I think a lot of that is just because we just haven't had any flare-ups across the globe at this point in time. And so there's no volatility really there over the last, say week or two. As far as natural gas has had a spike, from $3 to $7 an M, and now we're back around $3.15 an M. So all that polar pig Arctic, blast that we saw has essentially been taken out of the market. Yes, storage is back to normal levels. And so, determining how we set up for the summer, cooling season, it's all going to really depend on where we end, the basically withdrawal season. It looks like we're going to end up probably in between 1.6 and 1.7 TCF. So not a bad, but not an overly constructive environment, but not a bad environment for summer and into winter next year. So we're going to keep an eye on natural gas. As far as the equity markets, the thing I'd say is the equity markets have really been moving towards cyclicals. We've talked about this all year long. The Dow has really outperformed here. In the last week, the Dow was up 2.5%, 3%. The S&P was up 0.5%. So obviously the industrials, the energy, the cyclicals, that's where the money is going near term. And on the basically, the laggards tend to be the big tech, the telecom stuff of those names. We've talked about that for the last 3 or 4 weeks, so no real change on that front. As far as the energy sector, most of the oil majors, refiners, big oil service companies, they've all reported. And for the most part, we're looking at flattish, sort of down spending in 2026. We're going to be getting a lot of E&Ps here over the next, 1 to 2 weeks. And my guess is you're going to hear the same message, meaning CapEx for the first half of 2026 is going to be flattish, probably at best. We're probably going to see CapEx in 2026 also be around flattish. That is going to be expected. So, I don't think you're going to have a whole heck of a lot of fireworks coming out of those companies. As far as M&A, we talked about the Devon Coterra merger last week in the E&P space, and this week we have Transocean and basically Valaris in an all-stock transaction as well in the offshore space. And so all we'd say is we've been talking about that, I don't know, for the last 6 months, that we expect M&A in the energy space to increase. We are starting to see that. We'll see how things develop here over the next couple weeks and months, but we fully expect that M&A is going to continue in the energy space, and we think that's a good thing. So with that, Maynard, we'll hand it back to you.
Okay, great. Jeff, anything you'd throw in?
Yeah, just to piggyback on two things Mike was saying that just caught my attention. We are through earnings season for a lot of the integrated and oilfield services companies, but you kind of take a step back and look at year to date stock price performance. Some of these integrateds are up 20-25%. It's really big dollar moves. The second thing that's noticeable in that is just the E&P companies lagging within the energy stack. You've got you can see the big cap integrateds attracting meaningful dollars, but you also see some of the beta sectors like oilfield services up, some of them 30-40% year to date. The second thing, just on the Transocean Valaris transaction, there's lots of reasons why, but it's interesting and notable that there was a big premium in that, and the stocks actually did reasonably well. But I know we'll dive into much more M&A here with Bill shortly.
All right, Bill. As you and I were thinking about what we might talk about, you were kind enough to provide your annual review, your annual letter you write every year to CEOs and boards, just thinking back on 2025. Thanks for sharing it with us. It's really got a lot of great information in there. As you think about some of the highlights of that report and some of the big takeaways from 2025, what are the couple of things that just jump out right away?
Look, it was a very robust M&A year. And it took everyone expected it would be when Trump came in. Liberation Day put things on hold, but the second half was robust as heck, with a lot of big deals happening. I think people are very optimistic about antitrust. It's funny when you think about the flavor of deals, Maynard. I worked on an RMT deal, one of these reverse Morris trust deals, a $20 billion deal with Becton Dickinson, big cross-border deals like in chemicals with the Exalta deal, and also, hostile deals like right now with the folks at the Warner Brothers P Sky deal. So there's a lot of the flavors of M&A are out there. And when people ask what's driving that, well, it's certainly antitrust. Financing is pretty liquid right now. But also, buyers' stocks have generally done well. I mean, even you look at this past week with the Devon and the Transocean, some of these deals, Transocean, the stock price of buyers is going up, and that encourages CEOs. You couple that with the fact that Activism had an all-time high number of campaigns last year. If you're a public company, you're very focused on what's going on from the outside. And I'd say after Labor Day, the number of boards who asked us to come in to do reviews of where the market's going, have maybe 20 years ago, it's pretty severe. So a lot of change.
So there's a lot in there. We could go in a lot of directions here, Bill, but I was thinking, you mentioned activism, and a couple of the fun facts in your materials. Second biggest M&A year ever in 2025. Maybe the highest activism ever. And then you point to Elliott as like really I guess way out in front, or a significant part of all that activism, 20 different companies, I think the number was. But is there a reason in your mind that activism is ticking up, or what would you say about that as an industry?
It's an amazing space, Maynard. I've defended now 52 situations against Carl Icahn, and close to that with Elliott. So there's a lot of the bigger players you see time and again. Let me maybe outline 3 or 4 things that if I'm a public company director or management team, I'd be thinking about. One is that it has become risk management. When 20% of the S&P 500 have an activist in the stock, Honeywell, Pepsi, just go down the list. This is going to happen from time to time. More and they're getting, and you've seen this in your sector, Maynard, there are more and more CEOs or ex-CEOs willing to be on activist slates. The banks are working for activists. We were defending a company in Europe where they had two bulge brackets that were accumulating positions while they were defending the company. The CEO asked me, "What is that?" I said, "I think they call that synergies." So you've got more directors willing to work with activists, more banks. You better be prepared because you're not going to get noticed necessarily that an approach is going to happen.
You make the point that it's increasingly a tactic of an activist to accumulate shares through a large firm, through a bulge bracket, whatever you call them, and then sort of so you don't see it coming. Do you want to comment on that trend?
Yeah, look, it's our SEC rules are not so great, right? When you go over 5%, you're supposed to accumulate. You're supposed to file a 13D filing, but if you accumulate it through derivatives, you don't need to disclose that. You may not need to make a Hart-Scott-Rodino filing. So what's happening is that when the 13Fs come out, and February 14th is Valentine's Day for some, it's 13F Day for us. On that day, you'll see broker-dealer positions, and now people are focused on that because they're the accumulators. You don't know which activists could be behind the positions, but that's a key part of it. I mean, Maynard, it's amazing how much the shareholder bases have changed in the last number of years. And like when we announce a big deal nowadays, we have about 5 levels of PR with respect to it. We have a group to go into the hedgies, another that talks to the index funds, research, whatever. So the biggest change, however, though, is the index funds, which are like 40% of companies. And so when companies ask us, what do you do to engage with them? Is it still ESG? And I say, no, that's part of it, but they are like investors. They will take meetings, and there's an IR around it. Like, here's a couple of things, Maynard, we suggest to clients. Every quarter, you send them a short 1-page summary of earnings. And some companies say they don't respond. Well, let me tell you, when you go on a defense of a Southwest or a Phillips 66 or something like that, the index funds have a sleeve with the correspondence. And if you haven't corresponded, you're going to get hit. Another thing that we've done with companies, we did this with Silverbow. We invited the shareholders to present to the board, and that was one of the reasons that ISS supported us. Now, inviting shareholders to present to the board is not riskless, because we had one client where the director fell asleep during a Fidelity meeting, so you need to be careful if you're going to invite someone to the board. But there's a whole IR around the index funds, Maynard, in M&A deals, in activism situations, or just generally, that companies are catching up to, but not quite there yet.
So you mentioned ISS, Glass Lewis. These firms have always exerted a lot of control and influence. What would you say is the trend there? We've seen a couple of these announcements about firms saying we're going to vote our own shares now, as opposed to what would you tell us there?
Look, what you read in the press has little to do with what's going on in the field, number one. ISS and Glass Lewis have tremendous influence on SandPay and some of the more, they basically provide leverage to funds. They don't have to go through all these, analyses. But on proxy fight and mergers, the index funds and others generally took that work in-house and made their own judgments. So they would definitely have, like, the quants, the small shareholders would follow them, but it wasn't as profound, their influence, as others would think. Now, as you probably have read, JP Morgan, Wells Fargo, and others are now saying we're taking it back, we're not deferring to ISS, because in fights, they're hearing complaints from clients, like, why are you deferring to ISS, who supports activists the vast majority of the time? And so I think you're going to see different organizations using ChatGPT and things like that to do the analysis and maybe disintermediate ISS. The problem is someone still needs to make a judgment. One of the beautiful things for ISS, for funds, was to say, oh, I didn't vote against you, it was ISS. I could blame it to ISS. If you're making the judgment, you may have some angry clients if you make the ultimate decision.
This is oddball question, Bill, but do you think there's a role for a different kind of, like you made that
Yeah.
comment about people might use ChatGPT and figure out which way they're voting. Do you think there's a role for a new third-party intermediary to comment on where you recommend people vote?
Yeah. So a couple things on that. I mean, look, ISS and Glassdoor have been doing this for years. They aggregate this information very efficiently, and they provide people a judgment. You don't need to follow it, right? But Broadridge, for example, is from what I understand, developing their own, Chat GPT summary for companies. I think you're going to see a few doing that. But ultimately, someone needs to make a decision. And let's be clear, sometimes we get, I had a pitch a couple of weeks ago where the junior team brought all this great, cool analysis from ChatGPT, and me and one of my other senior partners looked at it and like, this is wrong. It's like, you better check on the aggregator and do some work around it. So the answer is, Maynard, people are starting to develop it. Broadridge is one. There may be a few others. They got to cost less than ISS, so the costs are coming down, right?
So one other thing, thinking about these proxy contests, the retail vote. The retail vote is always a bit of a mystery, and it's hard to get. And there's this in your materials, you talk about the Exxon initiative, where the retail might be otherwise aligned with management unless they vote differently. You want to talk about that? Are we going to see more of that?
Right now, everyone watched it with interest, right? And I guess the summary of that meter is basically Exxon would ask some of the retail shareholders, look, would you provide, in essence, the proxy for us to vote your shares, ostensibly pro-management around that. And there was some, gnashing of teeth around that. I haven't seen a widespread following on that. It's something that's new, different, worth watching, right? The retail is very, very hard to get to because, like most, as you know, most people who get their mailings in the proxy throw them out. But there are more and more, because of the internet and whatnot, there are more and more ways to be able to get to votes. And those votes generally are pro-management anyway. Mm-hmm. So it's an interesting idea, always like ingenuity, but I don't think that's happening writ large.
But if a company, just so we understand, a company could just propose that and try it. There's no, it's up to them. SEC still looking at some of it, and so I think there's still, and state law may impact this too. So it's still an idea that's being refined. I was thinking, you mentioned the SEC, but if we just said Washington, D.C. and SEC, FTC, the Trump administration, like, how do you think about getting deals approved right now? Like, what's your observation there?
Yeah. So let's start with sort of the regulatory approval process for deals, Maynard. Under the Biden administration, it seemed like every single deal got a second request. And to comply with that, $7, $8, $9, $10 million, that's like a cost on all deals, and it funded more aggressive issues. So that is kind of evaporated. You're back to normal on the basically second requests. Generally, you're seeing, when I say back to normal, you're seeing most deals approved, but there haven't been many that test. There's been one or two, but not many that test to say this is the rules have changed. I think tech is an area that people are focused on, whether things have changed on the antitrust. The bottom line, man, it's much, much better, and that's emboldening people. The EU also has been more reasonable. I'm not exactly sure why.
There's a comment. There's a comment you don't hear every day.
Yeah, no, it's look, tech is the wild card in all of these. It's sometimes they're pushing that. China is an area that I see clients wanting to avoid the review under almost all circumstances. So China, if you have exposure in your deal, has issues around that.
But by that, Bill, you mean like a CFIUS type situation, like
CFIUS type thing, because that's the next piece of this. So that's the antitrust. CFIUS is the wild card. I worked with U.S. Steel when they were doing their deal, and CFIUS came in and whatnot. What I would say is there is some level of protectionism that's happening that's uncertain, but also it hasn't been tested in the courts. When I was defending Qualcomm years ago, basically the guy doing the hostile was very close, publicly close to the Trump administration, and then 7 months later, the Trump administration came out against the deal as emphatically as you could imagine. So there's less process around CFIUS, so that's a little bit of a wild card. I'll tell you one deal tip, though. I think companies are being more careful about how they talk about synergies. In other words, if you get the regulatory, maybe if you're firing that many people, that could be part of the review process. And so that's nascent. We're watching that closely. But high synergy deals, I think, are being announced a little more carefully. But here's one. So on the SEC front, we're not seeing initiatives to be more aggressive against companies. I think the SEC is really trying to encourage more IPOs and figure out ways to do it. But here's a change that may not have been on your radar screen, but had a pretty big impact. A few years ago, the SEC changed the proxy cards. Now, in the good old days, you'd have the companies would have their candidates on a white card, and Carl Icahn or whoever would have theirs on a blue card, their director candidates. You couldn't pick from both cards unless you showed up. So it's kind of a hometown advantage. You'd have to really say, I want to vote on the blue card and not vote for any white card people. SEC made a rule change that said put everyone on one card. So it's like a Chinese menu. Makes it easier to pick people on and off. So I'm going to spend a minute, if you don't mind, about what that impact has been. The focus on the settlements that used to have with activists would happen in 10 months, 11 months of negotiation discussion. Now they happen in 3 or 4 weeks. Because what happens is companies say, they look at their board and realize they're very vulnerable, and they're like, let me just settle because I know these guys are going to lose in a proxy fight. The problem is the average tenure when you have an activist on your board is within a year sometimes for a CEO. So you may be not losing a proxy fight, but the CEO tends to come under pressure if you put an activist on the board. Now, every company's different, and some companies maybe, some shareholders would say deserve a kick. But I will tell you this, the dynamic of having an activist on the board does change in many circumstances. Now, when we say to clients, well, what do you do with that? The fact that the boards are under attack more individually, right? Well, we say when you think about your board, you should think about 3 categories and 3 types of people. 3 categories are diversity. That's still important to shareholders. Tenure. You're seeing more and more funds adopting policies that if you're on a board over 10 years, you shouldn't be on the board. And that doesn't happen until you have a fight. And so these directors, I'm fine, everything's good, and I've been on the board a long time. And then when they come to a fight, and some of these ISSs and the index funds say you're on too long, and they're like, you never said anything to me. And then they say, also, the director will say, hey, but I'm really good. I have all these things. And the index funds will say, if you're so good, you should have found your own successor. So tenure is become, in fights, more of an issue. And then a third issue is having people with expertise in the space. So a recent Elliott fight, for example, they had a whole bunch of executives in the sector, and the company had someone who was a good executive in another sector, head of the Boys and Girls Club, a lawyer, God help us. So having people in your board room who like investors would think about. So those are the 3 categories, 3 types of people: former CEO, former tough CFO, who can talk to cap allocation. And here's one that many companies don't think about, and you should, is having a former institutional investor, like from a BlackRock or a Wellington. It sort of says when you don't have shareholder viewpoints, and you find out they do have shareholder view. It's a good thing. Too many companies spend tons of time, 9 months, going through these studies of all the types of characteristics you have, and like, what are you looking for? A left-handed Bulgarian, cyber expert? No, shareholders generally want people in the sector who've made money. So this board focus it's accelerated the changes in boards and refreshment and whatnot, and it's a vulnerability if you're not thinking about it to some level. But also, when you see your index funds and other shareholders, you got to sell that you got a great board. Companies have to be a little more proactive. So very complicated area, Mayor. I thought it was worth a little bit more discussion.
Yeah, no, awesome. Mike?
Yeah, Bill, in the lead-in, we talked about basically the Devon-Coterra merger a week ago in the E&P space, and this week we have the Transocean Valaris
Yeah.
merger in the offshore drilling space. And what really kind of caught my eye in your 2025 year in review report was the sort of acquire stock reaction to mega M&A. And you sort of noted five factors. Talked about conservative math is rewarded, leverage still matters, repeat acquirers get the benefit of the doubt, complexity is penalized, and preparation shows. And I think those are all great points, but maybe kind of focus on, which of those 5 points really, if you kind of want to stack them and say, what are the most important points when you start going at these mergers? Is one or more important, or how do you think about this, and where do you think we go in the next 12, 18 months on M&A?
Let me give you some specific comments. A great question, right? So in a lot of situations, before we announce, we red team, blue team the announcement. Like, what are going to be the toughest issues you got to face? I don't think companies did that enough, right? To be honest and say, we want to get our deal done. We got to say, here's the vulnerability around this. I'll tell you the messaging on the outset. So if you're an investor, right, and you're looking at a deal, what are some of the things you're going to be looking at? How about cash flow, right? And is this better use of capital than buying back shares? And how resilient is the cash flow? So if you want to tell everyone about scale and all how great your assets are, they want to build a model. So much is so important at the outset to give the investors some sense of how the value will be created. There are some buzzwords I hate. Mergers of equals, that's viewed as a social thing to enrich, teams and not create value. So it's not to say there aren't mergers of equals. It's just calling them that. You got to be ready. They're pushing on that. And this point around scale, investors think CEOs love scale, and scale is important, let's be clear, but value is equally important. So look, value is so important in doing deals, but this communications, there's so many deals that have, a few of the ones on the list you looked at, that they could have done much better on that. Another thing that's a soft issue too, which has been important in some of these deals, reminding the shareholders that you've done it before in other deals, gotten synergies in other deals, that you have a board who has that expertise. So look, there are some of the factors you mentioned are important, but I do think communicating value at the outset, especially when there are so many ARBs in the stock and quants that kind of, if there's a reaction, it gets exacerbated on day one. Not to say you'll lose it. And then look, that this is not a topic that directly is germane to what you just brought up. But by the way, after you announce the deal, when I was a lawyer, I used to be jealous because the bankers would announce the deal and go away and wait for the closing dinner, and we'd be working on the filings and everything else. But now, if you're a banker, if you want to get your deal done and get the success of that, you better focus on making sure the shareholders understand when things pivot in the environment, when other deals happen, and stay on that. I think that's changed for the better too.
And Bill, maybe to stay on that topic, you talked about preparation, the red team concept and activity makes sense to me. In the text, you mentioned well rehearsed, investor ready, but also activist stress tested materials. Maybe just expand on what you think what you meant by that.
Well, look, there's a bunch of things. I think this point around the houses compared to buybacks is one, right? Here's another one. We had a deal a few years ago in the healthcare sector where there was a company that was an obvious takeover target, right? And so they bought something really big. And the shareholders said to them, why did you shop yourself, right? Now that you did this acquisition, it's going to be too big to acquire. Did you check the market? And the lawyers said, well, you don't have a Revlon duty. You're buying something. And investors are like, well, no. What we want to know is that if this is going to foreclose an option, you have a good answer for it. So when you think about, because I hate to put it as it is activist. I use the word, so I have to live with it, activist focus. But it's more of, if you were sitting as a shareholder, trying to make a judgment with limited information, what would be the types of things you'd be thinking about? Is this the right team to do the deal, as I mentioned? How does this compare to alternatives? You better think about that before you announce.
One of the things I was thinking about as well is just I know when there's an activist campaign, winning and losing, that's a gray area. But I wanted if you just maybe talk thematically, when there's tends to see change or not change at the board or strategy level. Are there any underlying trends that you observe around either the size of the stake in the company, the size of the company, the size of the AUM of the activists? Maybe just outside the merits of what the arguments are there some underlying kind of just quantitative dynamics you observe in terms of when the activist tends to have impact or not?
Look, I think it's a matter of the activist's reputation and the ideas. And so a couple of things. One is when companies get an activist in the stock and have a proposal, to try to get a sense, if the thing makes sense, maybe you should be looking at it, right? So the whole thing about putting up a moat, suboptimal. Second thing, they own 0.01%. Well, how much did Exxon own? Engine number one own of Exxon, like 0.001%, and they had severe impact and changed a lot of board members as a result of that. So this thing about how much they own is faulty for two reasons. One, a small fund can have impact, and number two, it doesn't cover derivatives, which you may not see. So you got to play it on the merits, right, on that front. As far as this whole winning and losing thing, again, if someone has an idea, you work with it. There's a lot of the best fights you never read about because you got to worry about Reg FD. You have a discussion. The activist fund may have done a lot of work. Problem is sometimes you're not ready to announce it because you have to get something in order. So you have that dance. But there's a category of stuff that I don't know if it's winning or losing. The companies do something that makes a lot of value creation. That's a great win generally, right? The problem fights tend to be when they want to force a sale at a fire drill, like this idea of like put the company up for sale publicly, and if no one shows up, your long only shareholders have sold. You're owned by ARBs, and you're negotiating in a fishbowl while that. This idea of like doing a public forced sale of the company, which tends to be difficult from a dynamic of getting good results. That's often a fight that there are winners and losers on. And the other one, obviously, is the change of CEO. There were tons of recent campaigns where the activists are trying to change the CEO. That's a bit of a zero sum too. So look, if it's about economics, and you're seeing a lot of campaigns, I think in Pepsi, Elliott had 3 different consultants on there. So there's more operational things in front, but the ones that tend to be more or tougher to get to a resolution that's constructive or forced sales and CEO change.
What do you think, Bill? Because you obviously see so many boards. What have you observed? You mentioned the composition, the three buckets that you talked about. But what do you notice about the board being on the same page, cohesiveness, having done a lot of work together around strategic issues? Like, what are your thoughts around a board alignment, I guess is the question.
So maybe a couple of, I'll hit it indirectly first, Mayor. I think if there's any kind of issue that you're facing a challenge on, whether it could be activism or some other issue facing the company, the minute the board is not united, somehow the market senses that. So having unity and alignment to the extent that you can. I've walked into boardrooms where there were 11 people and there were 11 different things said. And no matter what, I'd say, it's good we're all aligned. Because there's, both. I think that the board discussions are more robust, maybe because people want to feel that if they ever get a fight, they show that they've been in and really engaged. And it's generally been good. It's been better because you have more independence and whatnot as compared 10 years ago. I'd say the one thing that sometimes is missing is that everyone has been trying to construct boards that have cyber and all these expertise levels. A lot of them are short on sector expertise. And when companies start constructing the board, having more people with real insight into the sector, it's great to have all these experts, but someone who's actually run businesses in the sector is important.
Do you notice anything going on, Bill, with size of boards? Because a board of 8 is easier to manage than a board of 12. But 12 you can get more flavors and more expertise. Like, any trend there?
Rule of thumb is it's moving more and more towards 10 to 11-ish, right? You have a board that's too small, you can't fill committees, right? And there's so much committee work. You have a board too big, it's unwieldy. And sometimes that happens in transitions and deals, but you're definitely seeing a reversion to, that kind of board size, 10, 11, 12-ish as more of the mean. Then even in the last few years, it's moved in that direction, Maynard.
One thing you referenced in the materials that was interesting is increasingly, or last year saw a number of deals that were disrupted by a new player. Somebody jumps in to top the deal. Mm-hmm. Is there some reason why that's happening? Is that just associated with good M&A markets, or is it more acceptable? Like, what do you make of that?
Look, I think that's a sign of a healthy M&A market, Mayor, is that, at some level, it's happened enough. So let's talk about a couple of deal frameworks. I know we're short on time, but it is a sign of a healthy deal environment. That's number one. Number two is some of these deal jumps, an activist may take a stake and then have another player, a strategic or financial player, be the topping bidder, and there's almost like a joint effort around it. So that there's been a few of those, and probably noted in the materials. One thing I should, before we wrap up, should also focus a little bit on is how spinoffs. There's so many of them last year. You saw in our materials, but they're more complicated to announce. They're not giving you the initial stock price bump at the beginning all the time. Sometimes they do, but to get to the actual value, they usually wait for the spin to work its way through the SEC system and whatnot. And I think that time announcement and the actual spin allows people who are potential buyers to sort of take a look, to come in, and if they can handle the tax issues, and I don't want to get into that, that's too much. We are seeing companies jump in right after spin goes, and that's another theme on that front. So anyway.
Well, Bill, this has been awesome. We're going to lose you shortly because you got to run to another fire. I got one last question for you. This is something we notice.
Yeah.
Which is, companies often do a thorough examination of, quote, the macro and the long-term forecast for the world that's most relevant to them. Sometimes really big companies have huge publications in that area. Sometimes, smaller companies can't afford to do that, so they'll cite other studies. But it seems like everybody wants long-only, patient investors in their stock. And those investors are all about the long term.
Yeah.
This is a long way of asking, do you have a good rule of thumb for attracting better, more patient capital to your shareholder base? And is one way to do it through having a long-term vision that you are sharing with your shareholders?
Yeah, man, it's an outstanding question because every CEO asks us this. How do we get more long-only investors? So a couple of things that we have seen work is that when the 13Fs come out, take a look at who's investing in your sector, the Capitals, the Fidelities, the Wellingtons, so someone who's in others in your sector and increasing their exposure. And then reaching out to those companies at the CFO or CEO level, right? Send a note, I'd like you to be in our investor base, and do that to about 10 investors every quarter, because you're not really getting as much harvest of new investors in the conferences. You should do them, but let's be clear, getting those notes to those investors, hey, we think you should be in the company, we see you're investing, things like that. That's been the most effective way. It may not happen right away, but here's one other thing a lot of companies aren't thinking about. There are more and more family offices that are now investing in public equities. Gates and Cascade, Michael Dell, and all these, Agnelli, they're taking more. They're going to see this. I wouldn't be surprised in the 13Fs, you're going to see about 5% family office money in public companies. The longest term capital. Companies need to put into their IR plan going after some family offices.
Fantastic. Well, that's a great tip to end on. Bill, we appreciate you. Come see us in Houston. This has been really great. And Mike and Jeff, I'm sorry I hogged all the Bill time. I owe you guys, but thank you, Bill.
Maynard, great to see an old friend. Mike and Jeff, thanks for hosting us. Great discussion.
All right. Thanks, guys. See you soon.
Thank you.